We have a question. I trade breakout pullbacks. I would always need 3 to 4 point stops to make 1 to 2 points. Is that acceptable? I do that all the time. So can you use a 4-point stop to make a 1-point scalp? On most days, if the day's range is 40 points, I'm not going to do it. But if the range is 10 points, sometimes 20 points, and we're in a fairly quiet trading range, part of a 20-point day, sometimes I will risk 4 points to make 1 point, but only if I'm willing to scale in. So for example, let's say I placed a limit order to buy the 6 low. I'm probably not going to get my 1-point profit right away. I'm probably going to buy more 1 point lower. I'm probably going to use a 5 or 6 point stop. What do you know about probability? When you ask that question, you know something. You're saying, can I make a 1-point scalp using a 4-point stop? Immediately, what are you saying? There are always 3 variables, and you just gave 2 of them. You said big risk, small reward. So you automatically know probability. Anytime you have small reward, big risk, you have a bad risk-reward ratio. Your risk is much bigger than your reward. That's a terrible risk-reward ratio. If you have a terrible risk-reward ratio, you know that the probability has to be high, right? Because the guy on the other side cannot have everything going his way. So anytime you're using a wide stop, your probability is going to be high, but your wide stop means that you're risking a lot. So if you use a wide enough stop, you can pretty much buy any day and make money, and you pretty much sell any day and make money. If you use a 100-point stop and you buy at any point and then scale in 20, 30, or 40 points lower, almost certainly you're going to make money. You're going to make money probably 80% of the time. But occasionally, maybe 10 or 20% of the time, you're going to lose 100 points. But the math is okay. But back to your question, is it okay to risk 4 points to make 1 point? Only if you're not going to scale in. You have to be right 90% of the time, or else it's a losing strategy. And really good traders, I know, I've traded with a bunch of traders who win 90% of the time, scalpers who win 90% of the time. So it can be done. But if you're starting out, that is not what you should be doing, because you are not going to be winning 90% of the time. And also, you should not be scaling in. However, if you start getting some experience and some comfort, and you can trade small enough so that you're perfectly comfortable scaling in, then you can do that. But you're going to make sure that you're reading the market cycle correctly. You don't want to be buying in a really tight channel bear trend, because if you look at the 15-minute chart, you say, wait a minute. And on the 5-minute chart, it's a bear channel, but on the 15-minute chart, it's a bear breakout. Every bar is closing on its low. So you have to make sure that you're assessing the market correctly, which is easier in hindsight, but that's really key. If you're going to be taking small profit, big risk trades, and especially if you're scaling in, you have to really know what you're doing, and you have to be really comfortable with what you're doing. A lot of times, maybe I can find an example of something here. I'm looking for one specific thing that happens fairly often, and because I'm saying it happens fairly often, it's going to be hard to find. What I'm looking for is a reasonable buy. This is kind of an example of it, but it's not a very good example of it. But let's say 36 is a great looking buy. Bulls will buy the high. They'll use a very wide stop, and they're willing to scale in. They don't make a profit and it immediately breaks strongly to the downside. They'll buy more on the reversal up. And if this is a reasonable buy and the context is good and signal bar is decent, buying that reversal up and getting out break even is a logical strategy, even if you have a breakout like this, a 5-bar bear breakout. So to me, if I'm trading a fund and if 36 look like a pretty good buy, I would either buy 36 and then buy the reversal up above 44 or 45, or not buy 36, and then when I get down here, I'm thinking the scale on bulls will buy and we'll get back to that high, so I'll buy the reversal up. So, but that's the kind of thing that I'm talking about. If you have enough experience and you're pretty confident in your read of what the market cycle is doing, what the price action is doing, then you can do that. But if you get very stressed out and very upset and very worried as you get 4 or 5 bar breakout against you, obviously you should not be doing that. Not only because you'll mess up and not make money, more importantly, you got to like your job, right? And if you're stressing out and feeling really miserable and unhappy and tense, that's not fun. You don't want to do that.